Everyone is buying the S&P 500 index thinking 2026 is a guaranteed green year, but here is what they're missing. The valuation-to-growth gap is wider than ever. We've entered the era of divergence. In 2024 and 2025, a rising tide lifted all tech boats. In 2026, the tide is going out, and we're about to see who was swimming naked. Today, we're looking at the 7 fortress stocks: GOOG, AMZN, NVDA, ASML, CRWD, Visa, and MA. Some are overpriced traps, others are the only thing standing between your portfolio and a 20% drawdown. Number 1. Alphabet Inc. Is Google still the king of search, or just a legacy giant being eaten by its own AI? The consensus is that AI overviews will kill their ad revenue. The bears have a loud argument. They say AI overviews, those summarized answers at the top of your screen, are ad killers. If a chatbot gives you the answer instantly, why would you ever click a sponsored link again? It's a compelling narrative of self-cannibalization. But here's the reality the market is missing. Alphabet isn't just defending search, they are weaponizing it. This year, Google officially began testing ads directly within Gemini. By shifting from a keyword search to a natural conversation, Google is capturing higher intent data than we've ever seen. Think about it. Instead of searching for best running shoes, you're telling Gemini, I'm training for a marathon, I have flat feet, and I need shoes under $150. That isn't just a search, that's a qualified lead. The conversion rates on that data, they could be astronomical. Beyond the search bar, the fundamentals are screaming. The bull case is no longer just about ads. Google Cloud has matured into a beast, a $50 billion plus annual run rate business with operating margins hitting a rock-solid 30%. They're the preferred AI sandbox for developers, and that's a recurring revenue stream that's just starting to scale. Google is the only company that owns the entire stack: the chips, the models, the data, and the distribution. Betting against them in 2026 feels like betting against the internet itself. Number 2. Amazon. If 2024 and 2025 were the years Amazon spent like a drunken sailor on data centers and satellites, 2026 is the year the bills come due and the profits start rolling in. We're officially entering what Wall Street is calling the harvesting phase. For years, the bear case was simple. Amazon's retail margins were too thin and their capex was too high. The reality? That massive $125 billion infrastructure spend has created a moat that is now impenetrable. We're seeing a shift from digital AI to physical AI. With the rollout of Blue Jay, their next-gen robotic system, and Project Luna, an agentic AI that manages entire fulfillment centers in real time, Amazon is projected to slash $10 billion in annual operating costs this year alone. They aren't just shipping boxes, they are running the world's most efficient autonomous machine. Then there's the AWS story. While critics worried about Azure catching up, AWS just signed a massive $38 billion 7-year deal with OpenAI to supply secondary computing power. Between that and the high demand for their custom Trainium chips, AWS growth is accelerating back toward the mid-20% range. But the real wildcard for 2026, Amazon Leo, the service formerly known as Project Kuiper. The first satellites are officially live, and by Q4, Amazon will be a global internet service provider. This isn't just a Starlink clone, it's a vertical integration play that puts AWS at the edge of the planet. Amazon isn't just a store, it's a high-margin utility for the AI era. If you're waiting for a better entry, you might just miss the breakout. Number 3. NVIDIA. Everyone is watching NVIDIA's stock price, but the real story for 2026 is what's happening under the hood of the new Mercedes-Benz CLA. At CES this week, Jensen Huang didn't just announce a faster chip, he announced the ChatGPT moment for physical AI with the reveal of Alpamayo. For years, self-driving cars have been black boxes. They see a stop sign and they stop, but they don't know why. If a rare, weird edge case happens, like a traffic light outage or a bird flying into a sensor, the system often panics. Alpamayo 1 changes that. It is the world's first open 10 billion parameter vision language action model that uses chain-of-thought reasoning. It doesn't just drive, it thinks through scenarios step by step and can actually output a reasoning trace explaining its logic. It is the difference between a car that memorizes the road and the car that understands it. The bull case is about dominance through openness. By open-sourcing Alpamayo's weights on Hugging Face, NVIDIA is positioning itself as the Android of autonomy. While Tesla keeps its FSD stack closed, NVIDIA is giving every other automaker, from Lucid to JLR, the brain they need to compete. This locks the entire industry into the NVIDIA ecosystem. And the hardware? The new Vera Rubin platform is now in full production, delivering 10x lower inference costs and 5x the performance of Blackwell. NVIDIA isn't just selling chips anymore, they're selling the complete operating system for the physical world. However, we have to look at the bear case. The move to open-source models is a double-edged sword. While it drives adoption, it also commoditizes the software layer. If competitors can use NVIDIA's open models on cheaper non-NVIDIA hardware in the future, the moat could start to thin. Furthermore, regulatory hurdles for Level 4 autonomy remain high, and any high-profile failure of an Alpamayo-powered vehicle could trigger a massive valuation reset. With the Rubin platform ramping up in the second half of 2026 and Alpamayo hitting U.S. roads in Q1, the fundamental floor for this stock is much higher than people realize. NVIDIA has successfully pivoted from the AI training company to the reasoning company. In 2026, that is the only place you want to be. Number 4. ASML. If you want to know who really runs the world in 2026, don't look at the politicians, look at a small town in the Netherlands called Veldhoven. That is the home of ASML, the only company on the planet capable of building the machines that build the future. We have officially entered the Angstrom era, and the gatekeeper is a piece of hardware called the TwinScan EXE5200B. This is the high-NA EUV machine, a $400 million marvel of physics that uses anamorphic optics to print features just 8 nanometers wide. To put that in perspective, if a chip were a size of a football field, these machines are printing lines the width of a human hair. Without ASML, there is no 2-nanometer chip, no next-gen iPhone, and no sovereign AI. But 2026 is seeing a fascinating split in strategy among the titans. Intel has gone all in, claiming a decisive first-mover advantage by completing acceptance testing on these high-NA systems to power their 14A node. Meanwhile, TSMC is playing a game of calculated delay, squeezing every last drop of efficiency out of their older machines before making the jump. It's a high-stakes poker game, and ASML is the house. They win no matter who places the bet. Despite the geopolitical noise, ASML's order book is swelling. SK Hynix and Samsung are currently in a bidding war for these machines to underpin the 2026 HBM upcycle. ASML has officially placed a floor under their 2026 revenue, stating they don't expect sales to fall below 2025 levels. So, is the monopoly premium too high for your portfolio in 2026? Actually, the market might be underestimating the recovery, with TSMC likely to capitulate and start massive high-NA orders by late 2026. The growth runway is extending into the 2030s. My verdict? It is a rock-solid hold for current owners and a buy on any geopolitical-driven pullbacks. ASML isn't just a semiconductor stock, it's a structural asset. You're not betting on a product, you're betting on the fundamental physics of the 21st century. Number 5. CrowdStrike. July 19, 2024 is a date that will live in cybersecurity infamy. 8.5 million blue screens, global airlines grounded, and the reputation of the industry leader, CrowdStrike, seemingly in tatters. The consensus back then? They were finished. Trust was broken, and the single point of failure narrative was the final nail in the coffin. But the reality in 2026? CrowdStrike didn't just survive. They conducted a masterclass in corporate resilience. While competitors like Palo Alto Networks pounced with discounts, CrowdStrike did something smarter. They launched Falcon Flex. By offering customers free product credits and more flexible licensing as a sorry for the outage, they inadvertently accelerated the consolidation they were already winning. They moved thousands of customers onto the full Falcon platform faster than a sales team ever could. Today, the outage discount has evaporated, and the Falcon is flying higher than ever. The bull case is centered on a massive technological rotation. We are seeing a historic exodus from legacy SIEM, security information and event management tools, those clunky, expensive data hogs of the 2010s. CrowdStrike's next-gen SIEM grew over 95% last year because it only charges for the data you actually ingest, not the data Falcon already sees. It's a pricing model that is bankrupting legacy rivals. Even more exciting? The 2026 Cybersecurity Startup Accelerator launched this week alongside AWS and NVIDIA. CrowdStrike is no longer just a vendor. They are the venture-backed epicenter of the AI security world. By mentoring the next 35 AI-driven security startups, they are ensuring that every new innovation in the space is built to integrate with their platform first. However, we cannot ignore the bear case. The valuation is, quite frankly, nosebleed, trading at roughly 30x sales in a market that is starting to favor cash flow stability over hypergrowth. CrowdStrike has zero margin for error. Furthermore, the $500 million lawsuit from Delta Airlines is still grinding through the courts. While CrowdStrike argues their liability is capped, a surprise ruling for gross negligence would be a massive gut punch to the 2026 balance sheet. As of January 2026, CrowdStrike is in a corrective phase, trading slightly below its 50-day moving average. It's a best-in-breed company, but at these prices, it's a tough trade. My verdict? It's a hold for long-term believers and an accumulate only on deep pullbacks. CrowdStrike has proved its resilience. Now it has to prove it can grow into its massive valuation without another glitch in the matrix. Finally, we have Visa and MasterCard. If you think the war on cash is over, you're right, but the war for the AI agent has just begun. For decades, Visa and MasterCard have lived as a cozy duopoly, taking a tiny slice of every human transaction. But in 2026, the game changes. We are moving from e-commerce to agentic commerce. Imagine your personal AI assistant, let's call it your shopping bot, browsing the web, finding the best deal on a flight, and completing the purchase while you sleep. To do that safely, that bot needs a secure, tokenized way to pay that doesn't involve handing over your actual credit card number to a machine. Visa is leaning into its massive scale with the Visa Intelligent Commerce Framework. Their big reveal for 2026 is the Trusted Agent Protocol. It uses cryptographic signatures, think of it like a digital passport for your AI, to tell a merchant, yes, this bot is authorized by John Doe to spend up to $200. Visa already has 4.8 billion credentials globally. By becoming the security layer for AI agents, they ensure they remain the default rail for the next billion users, who might not even be human. Partners like Microsoft, Perplexity, and Stripe are already piloting these automated checkouts. If Visa wins the standards war, they win the decade. MasterCard, however, is being even more aggressive with their product features. They've launched Agent Pay and a revolutionary partnership with LoanPro called Loan on Card. Starting this year, your AI agent can do more than just pay. It can borrow. If you're buying a $2,000 laptop, your agent can instantly provision a fixed-term installment loan directly onto a virtual MasterCard in your mobile wallet. No ACH delays, no legacy banking friction, just instant digital credit at the point of sale. MasterCard is growing faster than Visa, 17% revenue growth versus Visa's 11%. Their value-added services, cybersecurity and data analytics, now make up nearly 40% of their revenue. If you want the stability of a fortress balance sheet and massive scale, you pick Visa. If you want the higher growth, more innovative fintech-leaning giant, you pick MasterCard. But honestly, Both companies are of similar high quality to me. If you have stayed so far for the video, thank you so much for the support. Here's a surprise bonus stock pick for you, Novo Nordisk. In early 2026, Novo Nordisk, or NVO, is in a unique position. After a massive valuation reset throughout 2025, the stock has transitioned from a high-flying momentum play into what many analysts now consider a growth at a reasonable price, or even a value play. Whether that is one of the best stocks depends on your risk tolerance regarding government pricing regulations and patent cliffs. Here is the breakdown of its 2026 valuation and outlook. In early January 2026, Novo launched the oral version of Wegovy. It is expected to be a game-changer for patients who are needle-phobic, and early data shows weight loss results, 16.6%, nearly identical to the injectable. The acquisition and integration of Catalent sites are expected to double U.S. supply capacity by mid-2026. This should finally end the chronic shortages that limited revenue growth in 2024-2025. FDA approval for CRWD, a dual-action treatment that could be even more potent than Wegovy, is anticipated in late 2026. This represents the next generation of their obesity franchise. However, under the new Trump Rx initiative, U.S. list prices for Ozempic and Wegovy have been slashed to approximately $350 per month, down from over $1,000. While this increases volume, it creates a low single-digit negative impact on global sales growth this year. 2026 also marks the year semaglutide, or Ozempic and Wegovy, loses patent protection in China, India, and Brazil. Generic biosimilars are expected to enter these markets immediately, compressing margins. On competition, Eli Lilly's Zepbound has continued to gain market share in the injectable space, and their own weight loss pill, orforglipron, is expected to receive FDA approval early this quarter. Looking at Novo Nordisk today, you are buying a dominant, highly profitable healthcare leader at a recession-level valuation. The launch of Wegovy pill and the eventual release of CRWD provide a clear path to double-digit growth by 2027 once the pricing adjustments are digested. If you have a 3 to 5 year horizon, NVO looks like an attractive entry point because the current valuation suggests the worst is already priced in. However, for a short-term trade, it may face volatility as the market reacts to the first few quarters of Trump Rx pricing impact. So, here's the summary of this video. We've covered the giants: Google's search pivot, Amazon's robotics harvest, ASML's 2NM monopoly, CrowdStrike's resurrection, and the Visa-MasterCard showdown. The 2026 market isn't about buying the S&P 500 and hoping for the best. It's about owning the companies that own the infrastructure of reasoning. Don't chase the hype, chase the utility. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. Let me know in the comments what you think. See you in my next diary.